Okay. Hello, welcome back. The Principles of Counting One. Still your host, Dr. B. Happy to have you all with us today as we talk about how to account for partnerships. In today's conversation, we'll talk about partnership style businesses. We'll discuss the different types of businesses, but we'll primarily focus on partnership accounting. And a partnership, as you know, is a business that's owned by two or more individuals. That's the idea of a partnership. So that's the kind of business we'll be focusing on today. I want to call your attention as to where you are in the classroom, which is why I have the classroom open right now. We are in week 12. Okay, so we are in the very last month of this course. The course ends on April 26th. April 26th is a Friday. Okay, it's the last Friday of the month. What that means is we got this week, then 13, 14. I guess you could call it 15. I call it 16. 13, 14, 15. That's it, right? We end up on April 26th. April 26th is also the day of the final exam for this course. And it's also when everything else is due. So if you look here, we have really 4 weeks remaining. Yeah. So my recommendation, because there's so much to cover in these 4 weeks, I would recommend that you work ahead. Okay, just to make it a little easier for yourself. All right, that's my recommendation for success for the next 4 weeks. I promise you, if you do that, you'll be very well off. Okay, so just think about it, but that's what I would recommend that you do. Also, for this week, as we go through partnership accounting, one of the things that you have to do for this week, just like you've done in a few other weeks, is we have another LinkedIn Learning certificate for you to complete. And this is on Financial Accounting Part 2. You did Part 1 a few weeks ago, if I'm not mistaken. And Part 2 is kind of the continuation of this. Now, the reason why I like this particular LinkedIn Learning certificate is that, as you'll notice when you're going through this certificate, there are a lot of the same concepts that we've already covered and will cover. Okay. Um, we'll look at things like the statement of cash flows. We'll talk about business valuation, this type of stuff. These concepts we're going to learn here over the next 4 weeks. Okay, so that's why I like the idea that we're doing this particular LinkedIn Learning Certificate now, because it will help to introduce you to those concepts as we prepare to cover them. Okay, so for this week, we have a LinkedIn Learning Certificate. Now, you've all done a very good job of doing the ones before this one. So, my recommendation, because as you already know, these LinkedIn Learning Certificates take quite a bit of time, I'd like you to start now. Okay, try to have it done by Thursday. So that way, you'll have time to take the quiz for this week. Right? So that's my 2 cents. My word of advice for you is to get started early on this LinkedIn Learning Certificate, and it'll help to prepare you for the future weeks of this course. All right? So, without further ado, let's jump into partnership accounting. And as I'd mentioned, if you have any questions along the way, feel free to unmute your mic and ask your question, or you can also type it in the chat. So, first, I want to talk about uh, the organization of a business. What does it look like? How is it formed? Why do we have partnerships? That type of stuff. We're going to talk about the characteristics of it. Then we'll jump into the calculations. and the accounting aspect of it. So, in business, as you know, there are a couple of different types of business. We have things like a sole proprietorship. That's where one person owns and operates the business. We have partnerships. This is where two or more individuals own and operate the business together. We have limited liability companies, also known as LLC. This limits the personal liability. It separates the personal part from the business part. You see, that's why I call it limited liability. We'll jump into more detail on that here in a little bit. And we also have limited liability partnerships, limited liability companies, limited liability firms, etc. You see the point. Then we also have what we call S corporations and C corporations. And this is where the businesses act as their own entities, pay their own taxes, and have their own shares of stock ownership. So for this part of our discussion, this lecture, we're going to focus on partnerships. So first I want to talk about how the partnership is formed. A partnership begins with what we call a partnership agreement. In this partnership agreement, two or more individuals agree upon the formation of the business. It's done in writing, it's a contract, it's legally binding. It identifies who the individual partners of the business are, what they brought into the business, also known as contributions, their percentage of ownership, any type of withdrawal agreements, dispute resolution, what happens when a partner withdraws, those types of things are all identified in the partnership agreement. So if you're ever thinking about starting a business with someone else, the first thing you need to do is draft a partnership agreement, okay, and identify these 7 areas. A partnership, it's important to know this, a partnership does not pay income taxes. What I mean by this is that the business doesn't pay the tax. The individual partners do. It's called a pass-through entity. Okay? Whatever the business earns in terms of income gets passed through the business and allocated to the partners, and that's based off of the partnership agreement. All right? A partnership is what we call limited in life. The partnership will eventually end. Why? Because the partnership ends at some point in time, whether that be through the death of a partner, bankruptcy of the business, etc. We call that dissolution. That's where the business dissolves. Yep. Partnerships have what we call mutual agency. This means that each partner is bound by contract. One of the not so great things about a partnership is this part right here, which says unlimited liability. Oh. Unlimited liability means that each partner, it means that each partner becomes personally liable in the event that the partnership cannot pay its debts. In other words, if the business can't pay its own debts, okay, then the partners are liable. And with a liability, that means that your personal assets are at stake. Your house, your car, whatever, right? So, unlimited liability. Something to be aware of. And this last one, co-ownership of property, means that the partner's assets are owned jointly by all the partners. the equipment, the all the other assets of the business are owned jointly by the partners. That's what co-ownership of property means. Okay. So earlier I'd mentioned there's a couple of different forms of business. All right. The business is developed either as a sole proprietor, meaning one owner, a partnership, two or more owners, limited liability company, LLC, an S corp, or a C corp. Okay, those are the different types of business. Within the partnership realm of business, there's a couple of different forms of partnership businesses. We have the general partnership, limited liability partnership. An S corp could be also a partnership type of business, and a limited life LLC can also be a form of a partnership business. Personally, if it were me starting a partnership business, I'd go for the LLC. Right? Why? Because it limits your individual liabilities. If something goes wrong with the business, usually your personal assets are protected. Yep. General partnership is where everyone's liable, right? Everyone has what we call mutual agency. Limited partnership, the partners have unlimited liability for the debts, but they're not personally liable beyond their original investment. Okay, so that's a good thing to know. With a limited liability, you're only liable up to your investment amount. Limited liability partnership, I like to just call this insurance. Okay, it means that everyone's protected from if one partner acts negligently against the company. Yep. An S corporation, this is common if there's like a lot of different partners. Okay, 100 or less. That's a lot. That's a lot of partners. This is very common among medium to larger size partnership businesses. One of the benefits of this is that the partner it's treated as a partnership for income tax purposes, and it has liability protection. Say, and then the last one, my favorite, the LLC memberships. Members have the partners have the same limited liability as owners of the corporation. Okay, income tax is treated as a partnership. In other words, the income tax is spread across all the partners based off of their percentage ownership. I'll show you what all this looks like. But this is just a general sense of the different types of partnership businesses. So, how do you choose one? Well, let's say you're looking to form a partnership business with one of your classmates, and you have a great idea, great product, and you want to get some investors, partners, right? How do you choose which one is best? This graph, to me, sums it up easily. When it comes to the limited liability side, general partnership doesn't have that. We know that. Business isn't taxed, the individuals are. Pass through entity, is what we say. The limited partnership, the limited liability is limited, right? But for the LLP, limited liability partnership, or the LLC, limited liability company, or the S Corp or the C Corp, there's limited liability. Meaning that the partners are limited in their liability up to the dollar amount of their initial investments. Okay? They're not personally liable with their personal assets like a house or a car. That's what I mean by that. The business in a partnership is not taxed. The individual partners are. So when the business earns revenue, revenue minus expenses equals net income, that net income is taxable. Okay? That's considered profit, right? It's taxable. So, but it's not taxed at the business level, it's taxed at the individual partners' levels, you see? It's what we call a pass-through entity. So it's important to know the differences between these types of businesses, yeah? So let's say, we're getting ready to form a partnership. We're going to go in business together, all right, as a class. We're going to go into business together. So we got to figure out, okay, great. How do we form this new partnership? There's a couple of steps, right? We got to account for the organization of the partnership. Partners can invest both assets and liabilities into a partnership. So let's say, for example, just for hypothetical example, okay, we'll say this. Let's say Sam and Tim, they decide to go into business together, all right? We're gonna open up I don't know, an apparel and footwear shop. Sam and Tim are, all right? So these two new partners, they decide to go into business together, so they start to form the partnership agreement. And part of the partnership agreement, it identifies what they bring into the business. So let's say Sam brings in, $40,000 in cash to get started, plus um, some equipment, okay, and a $10,000 loan from a bank. That partner, Sam, brought in both assets, equipment and cash, and a liability, a loan. Right? All partners of the business have the equal opportunity to bring in assets and liabilities, you see? But we have to make sure we account for it based off of what the assets are, how much it's valued at, and any liabilities that they bring in as well. Right? We make general journal entries to bring these into the business. I'll show you what that looks like here shortly. They're recorded at market value. Okay. Now these contributions impact the partner's capital account. A partner's capital account is considered equity. Remember the accounting equation. Assets, that's what the business owns. Liabilities, that's what the business owes. Equity, that's what the owners own. Assets equals liabilities plus equity. You remember the accounting equation. On the equity side, that's what the owners own. Okay. Within equity, we have a couple of different accounts that you need to be aware of. One of those is called an owner's equity account, also known as a partner's capital account. That account represents the assets minus the liabilities that the owner brought into the business, or the partner brought into the business, you see? So that each individual partner has their own partner capital account. So if Sam and Tim went into business together, they would each have their own partner capital account on the balance sheet under equity. Owners also have the ability to withdraw from the business, withdraw cash from the business. We call these owners' withdrawals. Okay? So they have the ability to take profits out of the business. Nothing wrong with that. That's, normal course of business. When it comes to the net income, which as you know is on the income statement, revenue, sales minus all your expenses equals net income. When it comes to the net income, it's allocated to the partners based off of the partnership agreement. Remember, the partnership agreement usually includes the percentage of ownership in the business. And that percentage of ownership is typically, not always, but typically done based off of what the individual partners brought into the business, what they contributed. You see? I'll show you what all this looks like through a couple of examples. But that's how we form a partnership. So, how do we bring it into a couple of transactions? Well, first we got to figure out, what each person is bringing into the business. Once we figured that out, and what I mean by bringing in is both assets and liabilities. In my earlier example, Tim and Sam, they brought in some equipment, some cash, and some loans. Okay. So as you know, the equipment and cash, those are assets. The loan, that's a liability. Right. So we set up all their accounts in our accounting system. Let's say it's QuickBooks, for example. I'll create an account called Partnership Capital for Sam, and I'll put in the balance based off of the contributions. I'm going to do that through a journal entry. I'll debit cash for the amount of cash brought in. I'll debit equipment for the amount of equipment brought in. I'll credit a loan for the amount of the loan brought in. And that difference, the asset minus the liability, that's going to be the capital balance for that partner. You see? That's the process we go through. It's easier for me to show you the examples of the entries. So here we have an example. We got two partners. We got Kayla and Hector. They decided, hey, we're going to create a new business called Boards. I assume they're selling surfboards or something fun like that. Oh, snowboarding. Okay, and skateboarding. And we'll throw in surfing in there too, yeah? So they're creating a new business called Boards, retail business. They purchase their stuff that they sell through their distributor, just like Macy's does, and then they'll sell their merchandise that they bought in to their customers. So here's the example. We got Kayla, we got Hector, two new partners, all right? They both brought in some cash. One of the partners brought in a building, and one of the partners brought in a loan. So we need to account for each partner's investments into the business. Now remember, investments include both assets and liabilities. So here we have Kayla. Kayla brought in some cash, okay, for $7,000. She brought in a building that was market value of $33,000. And she also brought in a loan, okay, a note payable. Remember, note payable, that's a loan typically. In this case, we'll say it's a loan from the bank, $10,000. That would leave a capital balance for Kayla of $30,000. How did we figure this amount, you might be asking? Well, as you can see, the total asset amount that Kayla brought in was $40,000. 33 plus 7 is 40. The note payable was for 10, so the liability was 10,000. 40,000 minus 10,000, assets minus liabilities, equals equity. In this case, 30,000. You see? That's how we figured out that Kayla's capital balance is 30,000. Make sense? It's just a matter of rewriting the accounting equation in some cases to find out what their balance is. Assets minus liabilities equals equity. The accounting equation is assets equals liabilities plus equity. But if you're trying to solve for equity, all you got to do is take that liability amount and put it on the other side of the equal sign. Now remember, every time you move something from one side to the other, we have to reverse the sign. It's that good old, what do they call that? Not, I forget. So much math involved sometimes. But another way of rewriting the accounting equation is assets minus liabilities equals equity. Okay? Still balances, you see. So that's the first example. The second partner, Hector, he brought in $10,000 in cash into the business. So for that transaction, it's pretty easy. We debit cash the 10,000, we credit Hector paid in capital account 10,000. Okay. Now, with partnerships, we oftentimes need to allocate the income and the loss among partners. Unfortunately, not every business generates an income. It's just, a fact of life. You're not always going to have a great year in business. You might have a terrible year. In most businesses, the first few years are usually pretty rough. Why? Didn't sell enough, wrong product, customers didn't like it, whatever. There's a lot of different reasons why business doesn't always work out well in the first couple of years. In a partnership, first couple of years, the partners might be sharing the loss. If those years are good, they're sharing the income, you see, what they need to share based off of the partnership agreement. I'll show you what that looks like. Remember that partners in a business, they're not employees of the business. They're partners. They're owners. Okay? Employees don't, employees, they collect a paycheck, every 2 weeks or month or whatever. They collect a paycheck. Employees do. Owners don't. No. Owners don't collect paychecks because they own the business. They don't collect a salary. They own the business, remember? That might not be true for like an C Corp or an S Corp, but for a partnership, it's true. Partners do not collect a salary. All right. They do, however, share in the income or loss of the business. And it's based on some kind of ratio. That ratio could be stated in the partnership agreement, which it usually is. It might be based on their capital balances, how much they brought into the business, invested in the business. Or it might be based off of an allocation, salary plus interest, based off of that ratio. So these are the three different ways that partnerships share in the income or loss. Okay? And I'm going to go through an example of each of the three with you. The first one is based off of stated ratios, and this could be found in the partnership agreement. Partnership agreement states that Kayla is expected to receive 2/3 of the income or the loss, and that Hector will receive 1/3 of the income or the loss. It's what we call a stated ratio. It's written in the income agreement. In the partnership agreement. So, The first year, the partners did pretty decent. They managed to come away with a net income of $60,000. Awesome. So, based off of that $60,000 net income total for the first year and the stated ratio agreement in the partnership agreement, we divvy up the 60,000 to the two partners. Kayla gets 2/3 and Hector gets 1/3. Okay, based off of the partnership agreement. So 2/3 times 60,000, that's 40,000. 1/3 times 60,000, that's 20. Okay, so we debit income summary. Remember the closing process. We talked about this in, I think it was like week 3 or 4. Yep. Remember the closing process. Yep, of the accounting cycle. We debit income summary, and we credit the two partnership capital accounts. Credit Kayla 40,000, credit Hector 20,000. You see? What about allocating it based off of their capital balances? Remember, their capital balances represents the assets that the owners brought in minus the liabilities that the owners also brought into the business, also known as their investments. So, as you recall from a few slides ago when we first set up the business, Kayla had a balance of 30,000 and Hector had a balance of 10,000. Looking at that agreed upon ratio, okay, we take the balance times the ratio percentage. 2/3, you can say 75%. 1/3, 25%. 30,000 times the ratio percentage, 75%. I'm sorry. You take the 60,000 net income from the end of the year times the 75%. That means we're going to allocate 45,000 to Kayla. Based off of that same logic, 25% times 60, we're going to allocate 15,000 to Hector. So, of course, this means that their balances, respectively, are going to go up after we make these allocations. You see? What about when we allocate based off of services, capital, and the stated ratios? What are the differences? Sometimes a partner might decide to give themselves an annual salary, which would be stated in the partnership agreement. Or they might be based off of interest or something thereof, okay? Here we have an example. The partners agreed to do an allocated salary. Kayla decided to give a salary of 36,000 and Hector salary of 24,000. Okay? Each partner in this partnership agreement is allowed an annual interest of 10% based on their beginning capital balance. That keyword is really important, beginning capital balance. So each year they would gain 10% based off of their beginning capital balance. Remember, Kayla, I think, was at 30,000 and Hector was at 10. And the remaining balance of income or loss is allocated equally. So now we have year 2. Year 2, the net income was $70,000. Let's see how we allocate $70,000. So end of year two, 70,000. Each partner has their own salary. So 70 minus 36 minus 24. Then we have the interest based off of their original balances. Kayla was at 30,000, Hector was at 10. So we add the salaries plus the interest for each partner. The total of that is 64,000. 70 minus 64 is 6. That remaining balance gets distributed equally to each partner, which is what we did here. 3,000 each. 6 minus 6, 0. Now you see the balances of each partner here at the bottom. Kayla's balance is 42,000. Hector's balance 28,000. What just happened there? Okay. Oh, okay. Here's the other example. Sorry. Let's try to figure that out. Let's say instead of the 70,000 that we earned in year two, let's say instead of if it was 70, what if it wasn't 70,000? What if it was 50,000? Well, that could be a problem. The reason why that could be a problem is because remember they both have salaries, right? Kayla has 36,000, Hector has 24,000. Last I checked, that's higher than 50. So that would put them in negative, right? And not to mention, they have the interest, 10% off their original balances. Right? So we add that together. $39,000 for Kayla, $25,000 for Hector, total of $64,000. That's higher than 50. Just as we had said, the partners share in both the income or the loss. So 64,000, that's higher than the income of 50. There's a loss. So we would share equally the loss between the two partners. 14,000, 7,000 each. So you see what that does to their balances. It reduces their balances. 32,000, 18,000. So remember, in a partnership, we share in both the income and the loss. So let's be very, very careful of when you're writing in your partnership agreement. Okay? Now, I want to show you a couple things. What the financial statements look like for partnerships. This kind of breaks it down for you, just to show you how those balances on the balance sheet for the partners is calculated. All right. We have the initial investment. We have salaries, interest, allocations, and then we have, which brings us to the total net income. So total net income plus the initial investment minus withdrawals equals the ending capital balance. Okay, that's what you have to know in order to calculate the ending capital balance just in case you might see a question on a quiz that asks you how to do it. Yeah. Okay, so we got Kayla, we got Hector. Now, what if someone new comes along, a third person that says, "Hey, I see what y'all are doing here with this business. That's pretty cool. I want in. I want in." So the partners discuss it and they say, "Okay, we'll let this new person in." The existing partnership cannot stand as it is because if we bring in a third person, the existing partnership won't be the governing system. So we have to dissolve the existing partnership in order to make those changes. So we amend a new partner. Therefore, we have to form a new partnership agreement. Now we got 3 partners. Okay? There's 2 ways typically a new partner gets into a business. Number 1 is they have the ability to purchase from the other partners. Meaning, I'm a new partner. Hey, Kayla, I'll give you $10,000. Hey, Hector, I'll give you $10,000. I'm buying in to the business. Right? That's what that means. The second way for a new partner to come in is to invest assets into the partnership. Instead of me giving Kayla and Hector 10,000 each, I'm going to put 20,000 directly into the business. Okay, that's investing into the partnership. So I'm going to walk through both examples with you. Purchase of the partnership interest. Hey, Kayla, here's 10,000. Here, Hector, here's 10,000. I'm buying into the business. You see? Directly from the existing partners. Cash goes directly to the partners, not to the partnership. You see? So here we have the example. New partner Terrell, okay? Terrell approaches Hector. Terrell says to Hector, "Hey, listen, I'm interested in joining your business, your partnership, and I'd like to buy into the partnership directly from you." Hector agrees. Terrell pays up front. Okay? Because Hector agreed to sell half of his partnership to Terrell for $18,000. Half of Hector's partnership is half of 26,000. That's the balance before the new partner came in. Okay? So half of 26 is 13. Now you're wondering, Dr. B, it says that Terrell's buying for 18,000. Why wouldn't it be 18 instead of the 13, right? So glad you asked. That difference, 18 minus 13, I'm going to show you what that looks like. So here we have the journal entry. We're transferring from Hector to Terrell, the 13,000. So that difference, you already know what happened, right? Bought in for 18, bought half of Hector. That extra went directly to Hector. Yeah? All right. New partnership can also be established when the new partner brings in assets into the partnership. So instead of paying Hector 18,000, Terrell could just give cash to the partnership. You see? In, uh, Increase the total assets. So here's what it looks like. So instead of Terrell buying in from Hector, Terrell's simply buying into the business. So Terrell buys in for $22,000 in cash. So what we do here is we just make a journal entry: debit cash 22,000, cash coming into the business, and credit Terrell paid in capital 22,000. You see, that's the easiest way to do it. I like that way. Now, sometimes when we admit a new partner into the business, and there's an agreement between the existing partners, those existing partners could get paid a bonus for the admittance of that new partner. Yep. What we call the cost of doing business in this case. There could also be a situation where a bonus gets paid to the new partner. Okay? This happens on rare occasion. Bonuses to the old partners, this is a little bit more common. So Kayla and Hector, they agree to accept Terrell as their new partner based off of Terrell's new investment of $42,000 of cash into the partnership. Okay. Terrell is to receive 25% ownership in the new partnership. Any bonuses are paid out to the existing partners equally. This, of course, is done based off of the percentage ownership. So, the current equity of Kayla and Hector is 78,000. Terrell brought in 42,000. That gives a total partnership equity of 1.2 million. 1.2 million times the 25% Terrell ownership means that Terrell will have an equity balance of 30,000. That difference, which is $12,000, gets paid equally to the existing partners as a form of a bonus, you see? This is what it looks like. So Terrell brings $42,000 of cash into the business, debit cash 42,000. Terrell's balance is 30,000 based off of what I showed you earlier. That would be, what do we say, 25% of 1.2 million. The bonus is paid to the two existing partners equally. 42 minus 30 is 12,000. 12,000 divided by 2 is 6. Each partner gets 6. In the case of a bonus being paid to the new partner, it looks something like this. The current balance of Kayla and Hector is 78,000. Terrell brought $18,000 of cash into the business. The total partnership equity in this scenario is 96,000. Terrell's percent ownership is 25%. That would give Terrell an equity balance of 24,000. 96,000 times 25% is 24. Now, based off of this information, each partner would receive the bonus. Yeah. So the way we calculate this is we debit the cash, 18,000 that Terrell brought into the business. Each partner would receive half of the 6,000. That's 3,000 apiece. The balance would be Terrell's equity in the business. Okay.
Because each program takes you far behind the law.
I'm sorry, Marlon, what was that?
Can you hear me, Professor?
Hey, yeah, I can hear you.
So, if Zane and Perez are receiving a bonus, why is their capital decreasing by 3,000?
Why is it decreasing? Oh, I see. Great question. So the reason why it would decrease by the 3,000 instead of increase is because that difference is what's being paid to Terrell. You see,
Okay.
because Terrell's the one that, in this case, the new partner is also receiving a bonus. That difference is what's being paid to Terrell in the form of a bonus. Does that help to clarify?
Okay. So, the cash that he invested, I understand that, but
So Terrell brought 18,000 in cash into the business, right?
okay. So you put in 18, and that changed the total equity of the business, and any difference is getting paid to him as a bonus.
You
And
got
the
it.
bonus is coming from the other two capital
Coming
accounts.
from the other two, exactly. The other two
Okay.
partners are splitting the cost of the bonus to Terrell.
That makes sense.
Cool.
Also, I have another question. Can
Yeah.
you go back a few slides?
Sure. To the old partners?
One
Bonus
more.
old partners or
One
one more?
One more.
Okay.
It
Is
was
it this one?
one before this one.
Before this one.
Yes.
Okay.
Before that one too.
All right.
Here.
Okay. Show me.
So Rashid invested 18,000, but Perez gives up 13,000 in interest. What happens to the other 5,000?
The other 5,000 was paid directly to Perez, which does not get recorded. So in other words, it's the cost of buying into the business. You see what I'm saying?
Mm-hmm.
So the agreement was, that Perez will allow Terrell to buy into the business at half of Perez's ownership. So that would be 13,000
Okay.
because 26 divided by 2 is 13. The remaining 5,000, 18 minus 13, is paid directly to Perez as a way of buying into the business. Does that make sense?
It makes sense, but it's not recorded.
We don't record it. We don't record
Okay.
that. Yep.
Okay.
Great question. All right, cool. Very good. Excellent question. Okay, we talked about that. We talked about the new partners. Okay, now let's say Perez has had enough. Hector says, it's been a great ride, but I'm going to go do something else. It happens, partners withdraw. They decide they don't want to be in the partnership anymore. We have to account for that withdrawal of the partner. This happens in one of two ways. That partner, in this case Hector, can sell their shares of their partnership interest to another person that's in the business, or the partnership can distribute the cash and other assets to the withdrawing partner. In other words, pay that partner that's leaving out. You see? So let's look at this. I'm going to show you without a bonus and with a bonus in the case of a withdrawal. Here we have a partner, Hector, who has decided to leave the business. In this case, let's see. Here are the balances. Hector has a balance of 38,000. Kayla has a balance of 84,000, and Terrell has a balance of 38,000. All right. In this case, since Perez decides, hey, you know what, I'm done. You know, I'm just gonna take what's mine. So in this case, Hector had a balance of 38,000. So we just pay out the 38,000. Debit Hector's account 38,000, credit cash 38,000, and then Hector's out of the business, just like that. Pretty easy. Now, if there was a bonus involved, Hector would receive the 38,000 plus his share of the bonus. Yep. Now here we have an example where Hector's leaving the business, and according to the partnership agreement, with Hector leaving, that Hector, in this case, would pay a bonus to the remaining partners. Hector would pay a bonus to the remaining partners in this example. Okay, so we debit Hector's balance 38,000. We credit cash 34,000. Why? Because Hector is paying a $2,000 bonus to the existing partners. Okay, that happens from time to time. Now, here we have another example where the withdrawing partner, Hector, is receiving a bonus from the existing partners. All right, so we debit Hector's balance 38,000. We debit both Kayla and Terrell 1,000 apiece, which is the bonus being paid to Hector for Hector's withdrawal from the partnership. We pay Hector 40,000 in cash. So all the details have to be disclosed in that partnership agreement. Yeah. Now, what happens if a partner becomes deceased? Okay, it happens. In that case, oftentimes the estate or the will, whatever you want to call this, is entitled to receive that partner's equity. Partnership agreement should have a provision in the agreement for this type of thing happening. Yeah, they typically require the books to be closed out, and whatever balance is there to be settled with the estate. Again, that partnership agreement, you want to make sure that it's very well detailed in the event of something like this happening. Yeah, and life happens. Okay. And one of the other things that could happen to a partnership is what we call the dissolution, liquidation of the partnership. Okay. The partners decided, hey, you know what? It's been a good run. Let's close the business. All right. So I'm going to show you what that looks like. Dissolving a partnership requires 3 steps. One is the gain or loss of the liquidation is allocated to the partners using their partnership agreement. All partners have to settle their liabilities. and anything remaining gets distributed to the partners based off of their capital balances. So 3 steps. Here we have an example. Capital deficiency simply means that the business is in debt, deficiency, or the partner's in debt to the business, deficiency. Yep. In this case, there's no deficiency, which means that all the partners have a zero or credit balance on their accounts. Everyone's good. Everyone's paid up. Okay, so the 3 partners, Kayla, Hector, and Terrell, decide to dissolve their partnership. The outstanding liability is an account payable of $20,000. So they got to pay their vendor $20,000. So we do this prior to the dissolution of the company. So how do we do it? Let me show you the steps. First is, if there's no deficiency, which there's not in this case, the first thing we're going to do is we're going to sell the land, sell the assets. Okay? Debit cash $46,000 from the sale of the land. The land was worth $40,000 when we first started this company, remember? Or building, whatever. So there was a gain from that liquidation of $6,000. That $6,000 gets distributed to all of the partners equally according to the partnership agreement. Second step, we got to pay that liability. Debit accounts payable $20,000, credit cash $20,000 to pay the vendor or whoever it is. After that, the third step is that the balances gets distributed to the partners. Okay, so how do we calculate the balances? Kayla had a balance of $70,000 plus the $2,000 received from the sale of the land in excess of its value, giving Kayla $72,000. For Hector, the balance was $66,000 plus the $2,000 from the sale of the land, giving Hector $68,000. To Tyrell, had a balance of $62,000 plus the sale of the land, $2,000. New balance is $64,000. The company had a total cash balance of $204,000 after the liability was paid. So, based off of their cash, based off of each partner's balances, they get paid out based on those balances, 72, 68, 64, respectively, for a total of 204. That's how we close out the business. If there's no capital deficiency. However, sometimes there might be. Capital deficiency means that a partner has a debit balance on their account, meaning they overdrew or the business just wasn't doing well, whatever the case is. Happens for a number of different reasons, right? Withdrawals may be for liquidation, recurring losses, etc. The partner with a capital deficiency must pay cash into the partnership to satisfy that deficiency. So here we have an example. The 3 partners agreed to dissolve. Here were their balances at the time. Let's see. Kayla had a balance of $19,000. Hector had a balance of $8,000. Terrell had a balance of negative $3,000. Okay, whoops. So what that means is that Terrell needs to put $3,000 into the business in order to pay off Terrell's deficiency. Okay? So debit cash $3,000, credit Terrell $3,000. That takes Terrell off the books, right? At that point, the balance is 0 for Terrell. The remaining two partners, they have balances. Kayla has 19,000, Hector has 8,000. We pay them out respectively. Now, what if, let's say Terrell couldn't pay the $3,000 balance? Okay? Or something happened to Terrell, whatever. Couldn't do it, couldn't pay the $3,000 that Terrell owed the business. No problem. That burden falls on the remaining partners. So we debit Kayla, debit Hector $1,500 each to make up for the deficit that Terrell had. Okay, and then whatever remaining balances that Kayla and Hector have get paid out to the partners. You see? It happens, you know. Again, everything needs to be spelled out in that partnership agreement. All right, before I let you go, a ratio. I know you love them. I know you do. So you've told me this multiple times, I'm sure, but you love ratios, and so I'm not here to disappoint you. Here's one called the partner's return on equity. The partner's return on equity, what this does is it helps us to understand the current and potential partners' evaluation of success on the partnership. Okay. Of course, the higher, the better. So here we have the formula. The partner's net income divided by average partner equity. How do you find average partner equity? We take the beginning balance plus the ending balance divided by 2. That's how you find the average. Okay? That's just a quick, easy calculation. Okay. Are there any other comments, questions, or concerns about partnership accounting? Y'all are good. Okay. Because next week we're going to talk about corporation accounting, which is slightly different. If you think of anything, let me know. Marlon, I see your hand.
Yes, Professor. This question isn't so much about partnership accounting, but more like accounting in general. So I know that you have multiple years of accounting experience, and you're obviously older for PhD. Um, how do how did you learn accounting? Were you like, I know you went to school, but were you self-taught, or do you learned on the way?
A lot of it was self-taught. In terms of the actual experience, yeah, a lot of it was self-taught. Uh, so about my story, right? So, when I was a younger student, in undergraduate, like the position that you're in now, I didn't really like accounting. I thought it was boring. I thought it was, I'm never going to use this. That was my mentality, you know. I just figure, oh, I'm never going to use this. This is boring. I don't need to know this. Until a couple years into it. So after I took my Principles of Accounting 1 and 2 classes, I got approached by a friend of mine's father who said, hey, you know, we're trying to open this business. Would you be interested in helping us open it? I thought to myself, it says, yeah, that'd be cool, you know? Young entrepreneur, just trying to make a little extra, side hustle money, whatever's. At the time, that's what I thought it was going to be. And he says, okay, so you're going to have to, keep track of the books. I'm thinking, I know how to read. No, not those kind of books. The accounting books. Okay. So I went out and I bought QuickBooks. learned how to use it, by watching a bunch of YouTube videos and learning how it's done, And I'm so at that point, now all of a sudden here I am using the stuff I said I was never going to use. you know, uh, and so it kind of pushed me into that situation, and so I had to learn. I mean, I knew the book knowledge. Yeah, yeah, I remembered some things, couple ratios, whatever, whatever. I learned. I remembered a couple of journal entries, but that was it. I was like, man, now I have to. Now I really have to learn it. So I started practicing and practicing, and that's how you learn it. Because you can read all day. You could read about anything all day. Doesn't mean you're going to learn it. Learning is not. I'm sorry. Reading is not learning. I don't remember anything I read. I never do. Okay. For me, I don't learn by reading. I learn by doing things. I learn by practicing it. And so I did a lot of that. And then, got into the business. I screwed up a little bit, just as anyone does, because when you're learning it on your own, it's difficult. And so that's how I got into it. And, recording a lot of sales and recording a lot of transactions. And then I began to really understand the connection of what my professor was trying to teach me about accounting and relating it to what I thought I would never be doing, owning my own business. That's how I was forced into it. And honestly, I started to kind of like it after that part. And I was like, oh, now I get it. It's like, because now you're connecting the dots between what you read and what you're doing. You see, that's why in this course, though I designed it the way I did, because that as you're going through each week, I got all this stuff for you to look at. Like the materials and the videos and all that, but the certificates are fun, right? Because you're applying what you're learning. The Excel files, right? You're applying what you're learning. They're exercises, they're not graded, but you're applying what you're learning. That's why the course is designed this way. Because I know that you're not going to learn it by reading it. There's no way. I mean, I can read formulas all day long, but I'm not going to remember it. The only way I remember it is by doing it. And so that's why the course is designed the way it is. And that's why the way I learned accounting was not by reading the book. It was by being forced to do it. So that's my 2 cents on it. And, Marlon, I know I went the long way of explaining it to you, but that was how I did it. So you might be put into a position someday. You might be put into a management position where you're managing a budget for multiple $1 million. You have to know some of this stuff, right? Or you might work your way up the ladder into management, or you might be a business owner yourself someday if you're not already. You have to learn accounting, because the way we manage a business is based off of the numbers. It's based off of the income statement, the balance sheet, statement of cash flows, retained earnings. This is how we manage a business. So that's why it's important for you to know, because someday you might be like me and going down that road that you never thought you were going to go down. Oh, hopefully that helps.
I know that you're teaching Principles of Accounting 2 in the summer.
Yes.
So, how's that class designed?
Same way, but it's a little bit more intense because it's over the summer and it's 6 weeks. Because summertime it's 6 weeks instead of, what is this, 15? So think of it it's designed the same way, just really condensed. It's a lot more information, a lot faster. I will also be teaching Principles of Accounting 2 in the fall as well, if if you wanted to wait till then. But if you want to take it in summer with me, you can do that. That will probably be in person on campus. The one in the summer.
You know, that's very.
Would you recommend taking it in the summer or the fall?
Depends on how you learn. If you think you'll learn in a condensed format in 6 weeks instead of 15, then summer. But if you're like, oh, I like to take my time with it, then do it in the fall. Yeah, it's all about your learning style. Good question. Okay. As a reminder, for this week, you have your Financial Accounting Part 2 certificate, LinkedIn Learning, okay? And you have your quiz. I recommend you do the LinkedIn Learning early because you remember those things take some time. If you have any comments, questions, or concerns about anything in this course, or anything else for that matter, you can feel free to email me, call me, or set up office hours. I'm always here for all of you. You know that. So thank you all so very much for your time today. I sincerely appreciate all of you and your hard work. But don't stop now because we only got a few weeks left. So keep your foot on that gas pedal and let's keep going. We got this. Thank you so much. Have a wonderful rest of your night. Take care. Bye-bye. Good night. Good night.